You're watching BCTV. We're all about Branford. You're watching BCTV, Branford Government Television, a service of Branford Community Television. This program is brought to you in part through the support of the Town of Branford.
Okay, we're going to get started with the Town of Branford Board of Finance regular meeting for Monday, May 20th, 2024. First on the agenda is to approve minutes of the April 29th meeting of the Board of Finance.
I'll move to approve.
Motion
second.
Been made and seconded. Is there discussion? All in favor?
Aye.
Before we go to item number 2, I would just like to offer the board's condolences to the family of Charles Shelton, who we understand passed away a couple days ago. Charlie was a very respected and contributory member of the Board of Finance for many, many years. He'll be sorely missed, and we thank him for his service and wish his family the best. May he rest in peace. Moment of silence, please. Thank you. Next up is citizens' communications. And if there's anybody in the audience who would like to offer any inputs or comments on tonight's agenda items, they're welcome. Peter?
First is a thank you, Joe. Pete Black from RTM 3rd District, and as with that hat on, I'd say that to urge your approval of the $20,000 that's proposed tonight for a water study. Short Beach Civic Association has previously put $18,000 towards this effort. That's how important it is to the people of Short Beach. At this point, that well is dry. And so I'd urge your approval of that. And the second thing, as far as, you'll be setting the budget tonight, I just urge you to keep your powder dry on our reserves when we're going to see a massive shift toward residential taxpayers in the neighborhood of 20% increase, even with the budgets being level because of the vast increase, or the disproportionate increase in property values for residential, vice commercial, and industrial. Thank you.
Thank you, Peter. Anyone else? I just acknowledge the fact that we did receive communication from Tracy Everson and John Hartwell with regards to fund balance information that was submitted by way of email. Just recognizing that, and we can include those in the minutes if you so choose. And then also, I did also receive an email from Victoria Verdermain, thank you, RTM member as well, with also some comments about fund balance and the budget. So just recognizing those, and no one else, no other communications or comments on the budget. I'm sorry, on the agenda. Not, we'll move on to item number 3, to hear from GYL Financial Synergies with regards to the performance of the Town of Branford's Police Pension Fund for the quarter ended March 31st, 2024, and if necessary, rebalance the portfolio. We will also do the same for the Volunteer Fire Incentive Plan, for the other post-employment benefit plan, and for the Coastal Resiliency Fund. Welcome, Michael.
Great, thank you. Good evening, all. So as we typically do, we'll start with a review of the markets and the economy. As we talked about last quarter, we typically develop these acronyms. Some of them are kind of silly, but they to address the salient points. And our acronym this quarter is a little bit tongue-in-cheek, but I think everyone will appreciate it. It's egg price. And as we all remember, back in the days a year or so ago when we were at $1 a piece for eggs at the supermarket. So starting with the E in our acronym is for employment. Unemployment continues to be relatively low, although interestingly enough, the most recent print showed an uptick from 3.8 to 3.9%, and the market took some comfort in that. It read it as it's more likely that that we're starting to see a little bit of a slowdown, and that the Fed will be able to reduce rates. If you actually peel back the numbers a little bit, it was more a function of the numbers were actually a little bit better than originally portrayed, in that the uptick wasn't really from 3.8 to 3.9, it was 3.83 to 3.86. So it was rounding as much as anything. But more significantly, the number of jobs created, although it came in lighter than expected, was consistent with what historically has been during periods of kind of moderate economic growth. So the job market remains reasonably strong. The first G in the acronym is geopolitics. I won't go into too much detail on that. We're all certainly painfully aware of the things that are going on in various parts of the globe. But suffice it to say, the market is kind of shrugging a lot of that off and doesn't view a tremendous amount of risk there, but it will in all likelihood continue to create some volatility, and certainly some headline volatility. But thus far, the market has kind of taken it in stride. You probably all saw over the weekend the president of Iran was killed in a helicopter crash. So will remain to be seen what if any impact that has on politics there. He was kind of widely viewed as the successor to the current supreme leader, who was in his mid-80s. Then the next G is for growth. We continue to see positive growth in the economy. We had very strong growth in the third quarter of last year, and then in the first quarter of this year, it has come back, but it is still a positive number. And I think the lesson from it is, despite all the talk of an impending recession for the past couple of years, we still have yet to see any negative GDP growth, and it continues to be a modestly positive number. The first revision to that number is due out May 30th, so that'll give us a little bit better a feel as we get more data. But growth is really, in a lot of ways, is essentially the growth in productivity multiplied by the growth in population. And that's the P in our acronym, is productivity. And one of the reasons why we continue to see reasonably decent economic growth is because productivity has improved. As wage growth has leveled off, that's freed up money for corporations to invest elsewhere. And we saw a nice spike in productivity in 2023. It's come back a little bit at the beginning of 2024, but certainly quite a bit better than what it was in 2022. The big wild card for productivity, of course, is artificial intelligence and exactly what impact it will have on productivity and how quickly it will come. We're at the point now where there's a tremendous amount of expectation and enthusiasm, but in all likelihood it will come in fits and starts. But as we as a population are not really having enough children to kind of grow that part of the equation, we're really going to have to, as a society, work to grow our productivity to continue with broad economic growth. The R is for rates. I won't go into too much detail on that. Everyone's sort of an armchair Fed watcher these days, but I think bigger picture, the higher for longer theme has pretty much been validated. The idea of 6 rate cuts this year has kind of proven to be pie in the sky. Whether or not the Fed will be able to cut rates later in the year remains to be seen. But I think in general, we take a somewhat simplistic view of this, but I think it is a reasonable one, and that is that inflation's a little higher than the 2% that the Fed would like to see, but it's manageable at 3.4, 3.5%, and especially on the back of of continued strong employment numbers. That keeps consumer confidence reasonably good, and so ultimately we think the economy can continue to handle slightly elevated inflation so long as the broader job market and the consumer remains healthy. The The I is, of course, for inflation. Inflation has certainly rolled over and is in, I think it was 3.4% was the last print, which is quite a bit better than the 9.2 we hit at the peak, but it's still above what the Fed would like to see for its long-term number. It's interesting if you kind of slice and dice the inflation numbers. However, we are starting to see it come in a lot of different parts of the economy. Other areas are likely to remain elevated. If you look at the last inflation print, the area that was the single biggest contributor to the elevated number was interestingly enough auto insurance, and I think that a lot of that is, to our way of thinking, is kind of systemic, if you will, in that automobiles are very, very high tech. Seemingly a fender bender with all the sensors and radar and cameras and what have you, when you're in the bumpers and what have you, can get very expensive to fix very quickly. And so in all likelihood, things like that will stay elevated, but other things are starting to come in, and we're actually seeing little bits of some deflationary pressure, the price of eggs being one of them. Although in general, we're still seeing inflation is a little bit higher than the government's long-term expectations. The C is for confidence. I talked about confidence a bit. Consumer confidence has picked up at the end of last year and into the beginning of this year, although it came down a little bit at the end of the first quarter. But since the consumer accounts for about 2/3 of our economy in a lot of ways, as goes the consumer, so goes the broader economy. And with housing prices remaining relatively strong, 401k balances and the like, along with a strong labor market, consumer confidence has remained relatively steady. And then lastly, the E is for elections. I'm not going to comment on the elections other than to say, it's, what is it, five and a half months or so away. That's an eternity in politics, so certainly resist the temptation to call the proverbial game after each basket is sunk. But I think in a lot of ways, remember Warren Buffett's advice, and that is, if you mix your politics with your investment decisions, you're probably making a mistake. And I think that's really important to remember, because it's very easy to get caught up in the noise and the emotion of it. But if we look back historically, we see time and time again, who's in the Oval Office doesn't have a significant impact on returns. It's dictated more by the broader economy and the broader economic fundamentals.
Question, Mr. Chairman?
Sure.
Michael, page 4.
Yes.
Market manufacturing PMIs, which I believe stands for the Purchasing Managers Index, and this is global. My recall in economics was that if they were at the 50% range there, things were good. Am I correct?
Yes.
And so my ask is, if this thing was a heart monitor, you'd be in intensive care because it fluctuates internationally so much,
Yes.
And I guess the answer, the question is the ask is, how do you equate this to your summary, which is to the left, giving your comment about the U.S. is in pretty good growth, especially 3 years ago when they almost hit 60, and then they dipped down, up, down, up, down, and I can't remember each one of those quarters in terms of either positive or negativity. So I just ask you, when you chart this, what are you looking to gain?
I think in general, I mean, it's one of numerous data points that we look at, and you don't put a tremendous amount of weight in it. But I think the overall lesson from it is that the broader economy is okay. It's not, we're not in a period of outrageous growth, but we're not overly anemic either, and we're certainly not looking at contraction in the immediate future. But it's not, we're not anticipating kind of off to the races. And I think the other lesson to take from it is, at this point, the U.S. has been and continues to be a relative source of strength around the globe. The big wild card in a lot of ways is probably China, and there's some evidence that and a lot of folks are thinking that there's probably a lot of value in China at this point, but China has certainly been a disappointment in the way in the speed with which they've reopened following COVID.
Thank you.
Okay, other questions on the overview?
Okay, so if everyone would please turn to tab 2, page 5. This will give us our 35,000-foot view of the police pension plan. And so as we usually do, we'll take a look back historically. The annualized return has been 5.65%, right on par with the benchmark, which was at 5.71%. That equates to a total return of 218%. Just a couple of ticks below the benchmark, which is at 220%. That return has come with about 7% less volatility in the form of the portfolio beta, where you see it at 0.93. So that all translates into a positive alpha. In other words, the return per unit of risk versus the expected return has been slightly positive. And that's really what we would expect from the way the portfolio is invested. The risk assets are indexed, so you'll have experience similar to that of the indices. And then the fixed income is matched to the liabilities, or more closely matched to the liabilities as it has been more recently, but it also has a higher credit quality restriction than that of the underlying benchmark. So that helps to mute the volatility, and certainly during times of economic stress and volatility, as we've seen in the fixed income market over the past couple of years, that has led to some relative stability in the bond portfolio. In dollars and cents, we started with $8.3 million on 4/1 of '03. Since that time, there have been net outflows of $869,000 and in earnings of $22,284,000, bringing us to $29,726,000 at the end of the quarter. Since the end of the quarter, we had a sell-off at the beginning of April, followed by a rebound in late April and into May. So since the end of the quarter, we've had about $37,000 in appreciation and withdrawals totaling approximately $416,000. And the value as of May 15th was $29,309,000. Turning back a couple of pages to page 2. At the top line, the return for the quarter was 2.73%. The return for the trailing 1 year was 11.37%, a little bit ahead of the benchmark for the quarter, a little behind the benchmark for the trailing 1 year. Then when we get into the 3-year, 5-year, 10-year, and since inception, performance pretty consistent with the underlying benchmark at 302, 567, and 475. Respectively. Equities continue to be strong, particularly the domestic equities. You can see they returned just in excess of 20% over the trailing 1 year, 6.75% for the trailing quarter. Fixed income slightly negative for the quarter, although less negative than that of the underlying benchmark. That's because rates spiked up again at the beginning of the quarter, since have come back in a little bit. And then the high yield bonds continued to be additive relative to the investment grade fixed income. I just wanted to make one other observation with regards to the fixed income portfolio, because certainly there's a fair amount of talk about fixed income, and it can be discouraging to see the decline in value of fixed income. But I think it's important to remember exactly the role that it plays in the portfolio. Not only have we made the fixed income portfolio more closely aligned with the duration of the liabilities, so they tend to move kind of in opposite direction of each other. And so when we get that decline in value from higher interest rates, you also get a decline in the present value of your future liabilities. But if you look at page 14 of the report and page 2, I think it's just worth noting, and this is just in the bold area at the bottom row on page 14. It's noteworthy, if you look at the price at 98.2, what that means is bonds all mature at 100 essentially. So there is kind of some built-in appreciation that will come as the bonds in the portfolio approach maturity. And also, if you look at the second column in from the right, which says YTW, which is short for yield to worst, in showing that the yield on the portfolio is up north of 4.75%. So certainly, again, kind of consistent with the changes in the bond portfolio, we're able to capture more yield than we have been able to in many, many years with regards to the pension.
Thanks, Mike.
Okay. So the first page, or the top of the handout that you have, here we have our rebalancing spreadsheet. As you can see, we're really spot on with our targets at 51.9% for fixed income versus a target of 52%. A little bit overweight in equities at 47.3% versus 45%, and underweight in cash. We've already made the May benefit payment, so there's enough cash to make the June benefit payment, and I've spoken to the finance director about the July contribution, so we don't need to rebalance to raise cash. We're good for the June benefit payment, and then the contribution will be made before the July benefit payment. So no recommendation to rebalance the police pension today.
So no rebalancing?
Correct.
Okay. Questions? Police pension? Thanks, Mike.
Okay. We can move on to tab 3, which is the OPEB trust. OPEB trust, of course, as the Board of Finance is aware, there was a transition recently in that as interest rates have started to come up, some work was done with the finance director as well as your actuary to model out the potential for accelerating the investment of those T-bills that were, and so those monies were invested in a duration matched fixed income portfolio. So now we have the duration of the OPEB investments more consistent with the duration of the liabilities. That was approximately 24 years or so of liabilities that were matched in the OPEB. So that really is it's pretty fantastic, actually, when you look, especially when you look at kind of the state of a lot of the OPEBs around the state of Connecticut. Branford is really at the top of the pack. But starting again with on page 6, at a very high level, our annualized return is at 5.21%, consistent with but slightly behind the benchmark, which was at 5.35%. That owes primarily to the more conservative nature of the OPEB trust and in kind of the speed or the slowness, should I say, that we dollar cost averaged into the market. So our volatility has been quite a bit less than that of the benchmark, about 14% less, and that translates to a positive alpha you can see at 5 basis points. In terms of dollars and cents, the OPEB started with $4 million on July of 2011. Since that time, there's been about $24.8 million in net inflows and $11.3 million in earnings, bringing us to the ending value of $40.226 million. Looking back on page 2, the OPEB trust, of course, in contrast to the pension, much heavier in fixed income because of its funding status and the recent changes we made to the fixed income portfolio. And the return for the quarter was at 1.69%. For the trailing 1 year, we're at 9.44%, 3.05 for 3 years, 5% for 5 years, and 4.56 for 10 years. Again, primarily passively invested. The active strategy really is on the bond side, and in the short time since we've made these adjustments to the bond portfolio, although bonds have sold off a little bit, slightly less than the underlying benchmark. You can see similar illustration back on page 14 of this report, and you'll also see, and just kind of focusing in on the duration more than anything, the duration of the OPEB portfolio at 10 years. So again, more consistent with that, the underlying liabilities. Since the end of the quarter, there has been a decline in value of $288,000 and withdrawals of $155,000, and so the value as of March 15th, $39,783,000. In discussions with the finance director, we had kind of looked at a few different things. One is that we are getting low on cash, and since money is being drawn out of the OPEB monthly now, we do need to raise some cash for that. But we had also decided that now that we've embraced this liability-driven investing and consistent with the Board of Finance's historical desire to be a little more conservative with the investing, as risk assets, equities in particular, have increased in value, we are recommending a rebalance on the OPEB trust we would take about $685,000 from equities and about another $81,000 from high-yield bonds, and so that's about $766,000 would be deployed into the core fixed income portfolio if the board is to approve this rebalancing.
So you're showing that to go into cash, according to this?
Yep.
Right, for now?
Yes.
Okay, gotcha. Okay. Questions on Michael's presentation, or?
I'll move the rebalancing, Joe, based on the presentation.
Moved by Jeff,
Second?
seconded by Harry. Questions, discussion? All in favor?
Aye.
Okay, Michael, you're good
Okay.
on that.
All right, so moving on to tab 4, page 5, the volunteer fire plan. Again, primarily because of the historically high cash position as we've averaged into the portfolio, slightly lower return than that of the benchmark at 577 versus 608. However, that's come with about 7% less volatility, so we have a slightly positive alpha. It's only 1 basis point, so fairly modest, but slightly positive. Starting when in 2015, when the police pension and the fire pension were bifurcated, so we basically started with zero, or there's $56,000 was the initial deposit, and then another deposit of 1.1 million, and then earnings of $563,000, bringing us to a value of $1,719,000 as of the end of the first quarter. In the interest of time, I won't go too much into the details of performance. It's very similar to that of the police pension. The only real difference is because of the amount of dollars, you don't have a separately managed bond account. You're just in a bond index fund, a Vanguard bond index. But return for the quarter was 3.71% and 12.28% for the trailing 1 year. Since the end of the quarter, we've had about $4,700 in withdrawals, $13,000 in earnings, and so the value as of May 15th was $1,728,000. We are going to recommend a partial rebalance of the fire plan, and if you look at the right-hand column of your fire rebalance spreadsheet, you'll see there's a lot of zeros. Those were just very small trades that it didn't seem to make a lot of sense to do. However, we are overweight in cash. We're at about 6.4% versus about 2.5% in cash, and so we do recommend a rebalance as illustrated, which would mean about $117,000 going into fixed income, and about $17,000 coming out of the developed markets international, and about $31,000 coming out of the S&P 500.
Okay, thanks, Michael. Questions on this recommendation for rebalance?
I'll move it, Joe.
Moved by Jeff,
Second.
second by Victor. Discussion? All in favor?
Aye.
Okay, Michael, thank you. Next is,
So next is CRF, or as I've heard it referred to, Jim's CRF fund. But on page 4 of tab 5, the CRF has been the beneficiary of of kind of some of that methodical investing and into market volatility. And although we had a downdraft right after it was invested, it's since recovered nicely. Annualized return, being a heavy in bond portfolio, is still modest in absolute terms. We're at 1.22%, but more than double the benchmark, which returned 0.47%, and that's come with about 11% less volatility. So we actually have a pretty high alpha here at 6, although we're talking about a relatively short time horizon and relatively small sums, so these numbers are somewhat exaggerated based on that. Since 10/1 of 21, total or initial contribution of $1,925,000, just under $525,000 in cash flows, and $102,600 in earnings, bringing us to $2,552,000 at the end of the quarter. The CRF is heavy in fixed income by statute. We are at 65%, or 64.2% as of the end of the quarter, and about 35.8% in equities, so our return for the quarter was 2.1%, for the trailing 1 year at 8.68%. Since the end of the quarter, modest change. There was about $1,900 in withdrawals for fees and $11,400 in earnings. So value as of May 15th, $2,562,000. We're well within the target of the policy, both your investment policy as well as the statute, and so no recommendation to rebalance the CRF today.
Okay, thank you. Questions from Michael on the Coastal Resiliency Fund? All right, you're all set. Thanks, Michael.
Thank you very much.
Take care.
You too.
Next up is item number 7, which is to consider and if appropriate, approve the following transfer request for Registrar of Voters. And from various accounts, election workers, $7,000, equipment rental, $3,000, seasonal part-time, $220, educational incentive, $900, moving and storage, $1312, building rental, $100, membership of the meeting, $491, meals supplies, $1601, for a total of $14,626. And the request is to transfer that into deputy registrars for $10,000, overtime for $10, professional development of $1,000, other supplies for ballots, $3216, and travel, $400. We did receive a good letter from the Registrar of Voters, and Peter, you're here to represent that?
Yeah, I think everything's in the letter. If you want me to review it, I can. Otherwise, if you have any questions, happy to address them. Mostly this is making adjustments after the presidential primary. The dust has settled a little bit on what we paid for election workers and what had to come out of full-time hourly staff. We weren't able to hire as many part-time people as we might have liked, so there's an increase in some of the hourly paid people. And then there was a kind of a misunderstanding about the cost of ballots beforehand, but these are just essentially adjustments after the election. They're all intra-departmental.
Thank you, Peter. Questions on this request?
I'll move it.
Moved by
second it.
Victor, seconded by Harry. Discussion? All in favor?
Aye.
All set, thank you. Number 8 is to consider and if appropriate, approve a request from the Finance Director for fiscal 2024 from fund balance, $20,000 into East Shore Health District water study, $20,000. We do have a letter here from the East Shore Health folks, as well as Jim's letter. Jim, you want to provide an overview of this? Oh, we got Michael here as well, so I'll let you be up first, Michael. Welcome.
Good evening. And Joe, word is you're in your golden years.
I'm working on it. Thank you.
So good evening, Michael Pascasilla. I'm the Director of Health for the East Shore District Health Department. Quickly, background, we've been doing a lot of water quality analysis on the Farm River watershed, both on the East Haven side and Branford side. And on the Short Beach area, we have found that Clark's Beach or Johnson's Beach has the 4th worst water quality of 37 beaches on Long Island Sound. And so over the last 14 years, we've been studying it, and we have identified canine waste as about 85% of the hyper-local pollution coming out of the Short Beach area. However, when we go up the Farm River, we have some areas of concern, some hot spots. We've also talked to the state and the town of East Haven. While we applied for several state grants and some private grants, several of them we did not get. And so we're asking the town for $20,000. We also put a proposal in to the town of East Haven for $20,000 because that watershed is shared by both towns. The budget for the $20,000 is, and I gave the breakdown. So at a high level, we have a PhD student that's going to be with us for 2 years. She's a part-time student. And we've been paying her for the last year. I should say we have her for 4 years. But we're on year 2 now. We have 2 more years. For $5,000 for water quality interventions, we're asking for $3,000, and then $12,000 for the testing. What we're doing is microbial source tracking, where we actually do DNA analysis. The state lab prepares the samples for us, and then we send them to a private lab, and they do species identification. So first test is animal or human, and when animal contamination is found, we do species identification. Each sample is about $400, and we plan to do at least minimum of 150 samples. And so we're asking the town for some support. From our budget, we're taking some funding out, again, sharing it with East Haven. $10,000 was already allocated from the state of Connecticut towards this study. And so that's it in a nutshell.
Okay, questions from Michael on this?
Just a question around the, once the testing is done, is that going to be the plan then to put in place for remediation, or as I see that?
Yes, well, we already, from a very hyper-local contamination, we already identified canine waste as the #1 source, but that's just in the Short Beach area. By going up, we're, through that testing, once we identify other sources, there'll be some interventions done. So initially, we've already started our interventions on the canine waste. And as we go up to Farm River, we're going to be looking for other sources of contamination. I should also say that the Short Beach Association has already put in about $20,000 of funding. And I put a breakdown in there, about $18,000 was funded for the first round of sampling in that area by the Short Beach Association, and another $2,000 for the trash can improvements, and they have committed several more $1,000 towards the intervention. So short answer is yes. We've already started it, and as we identify more sources, we'll do more interventions.
Is it the local residents with their pets that are causing that, or is it from?
At this time, that appears to be the main source, yes, local
So there's
pets.
an education around that? And
Yes, yeah, we've already started the education. We are planning to do some street art around the storm drains, marketing campaign with the Short Beach Association. They put together their own committee, and we're assisting them. Our intent is not to do enforcement, is to do education, behavioral changes. However, enforcement can be an option, but it will absolutely be the last resort.
And so, other questions? So this really fund balance is from the ARPA fund balance. So I'll just read a proposed resolution here. Resolved that the Board of Finance recommends to the RTM an increase in the cumulative ARPA fund appropriation from $7,690,000 to $7,710,500. This appropriation will provide a grant for the East Shore Health District to conduct water study in the Short Beach section of Branford. That is the resolution for consideration.
I'll move that resolution.
Second, Joe.
Motion's been made and second to adopt. Discussion. All in favor?
Aye.
All right, Michael. Anything else, Jim?
Yeah, I was just going to say, it should be 7,690,500. As I'm doing this, I'm saying, oh, it should be 500. 7,690,500. There's a typo there.
Typo from,
Yeah, I think
that your
when I
typo?
looked at it, I looked, it's against my eyes, basically.
So what should the number be? It's 7,690,000?
500.
500, I got you.
Yeah.
Okay.
Yeah.
So we'll note that as a typo.
Yeah.
Fair enough.
Yep.
Joe, just a question. Michael, has East Haven addressed this request for additional money?
So I've already talked to the mayor's office and met with them last week. I put a proposal in, and like the town of Branford, they're in the process of putting together a transfer with the ARPA funds also.
Thank you.
So it's in the works.
Thank you.
Thanks, Michael. I think we're all set. Appreciate it. Good luck.
Thanks for the support, folks. Selectmen, thank you. And I should note, when the study is over, there'll be a research report that we will share, and we plan to publish this. So
Okay, good.
we'll share the final report.
All right.
It's going to take a few years, but we'll get there.
All right, thank you.
Thank you.
Have a good evening.
Same to you, thanks. Okay, next is item number 9, to discuss a follow-up memorandum from the Finance Director with regards to reevaluation of future budgets. We did receive a memo from Jim. You want to walk us through that, Jim?
Yeah, it's fairly straightforward. You may recall at the last meeting, we spent considerable amount of time talking about future budgets, fund balance, revaluation, and sort of basically overlaid a prior meeting's multiple-year plan and looking at it in the context of revaluation. And one of the things I had mentioned at the meeting is that the shift is such that it's not going to be offset totally by the change in the mill rate. And that was in conversations I would have with folks who instinctively think that, well, if my assessment goes up, my mill rate's going to go down to offset that. I think what this tries to do is clarify the degree in that relationship. So it doesn't totally offset it, but it's not to suggest that the lower mill rate doesn't have any impact. And so I just took a property, and based on conversations that I've had with folks, and looking at the mill rate change that was projected in that analysis, and then in the example, you can see that the value goes up 45%, and using an estimated mill rate for next year of 30.48 mils, the increase would be 17%. It wouldn't be the 45% increase in the assessed value. That seems to be more closer to what Peter Black had mentioned at the beginning of the meeting as well, about somewhere in the 20% range. So it was just to kind of take that presentation and identify a specific property to show the relationship between a 45% increase in the assessment with the projected mill rate. So it's just
Okay.
added an example.
Thanks, Jim.
Yep.
Questions on Jim's memo to us? Good. All set? Okay, no action needed on that. Item number 10 is to hear an overview of the fiscal 24-25 budget highlights from Finance Director and for the board to set the mill rate. Jim has also prepared an overview. Do you want to walk us through this, Jim?
Sure. So basically, when the RTM voted on their budget, they basically incorporated just about all of your recommendations with one exception, and that was $1,812, which the RTM recommended pursuant to a recommendation from the first selectman to adjust the salary adjust the stipend for the town band director. So that being the only change, so that essentially answers the question of, well, where is the RTM going to fall on the Board of Ed? Where is the RTM going to fall on the fire staffing analysis and changes? And so I think it's fair to say that both the Board of Ed and the fire department were successful because those items were approved as recommended. The other piece of this then is, well then what then is next for the Board of Finance, and for those who may be new to Branford, the RTM in its budget role can decrease the budget, they can't increase it. When that budget then gets transmitted to the Board of Finance, the Board of Finance can't make budget adjustments, but the Board of Finance can adjust the mill rate through essentially additional revenue or tax collection rates, etc. And this sort of dovetails from the last meeting in which we were looking again at future years with, in the context of reval, in the context of the debt plan, in the context of the fire enhancements to improve the response time to 4 minutes or lower. And essentially it was, and police as well, but it was essentially a public safety driven budget. And then overlay that with sort of the bookend approach where we were talking about possibly providing some relief in 25, knowing that that the revaluation is going to hit, and despite some of our best intentions, it is going to be very difficult to mitigate that shift. I mean, there are some things we can do, but like I said, I want to be realistic about the expectations on that. In the context of those discussions, we talked about a 2% increase. And the budget that came back to the Board of Finance was a 2.58%, which was based on the original budget that you recommended, because there were no net changes to the budget. And then what I did is I looked at, and there's a spreadsheet which basically shows basically two scenarios. One is if you set the mill rate based only on the RTM approved budget without any revenue adjustments, and of course that brings you back to the 2.58% increase. The other is if you make adjustments, primarily taking additional money out of the fund balance to meet your target or meet the discussed target of 2% from our last meeting, then it would end up being, like I said, basically a 2% rounding budget increase. And then the third column, it's not anything that anybody's voting on, but it really, I thought it was important to put 25 in context. And as I alluded to in my memo, you often hear at meetings such as this, and RTM meetings and March meetings of the Board of Finance, that what's being proposed is a status quo budget. In other words, we're continuing existing programs, but we're not adding any new or different programs. And this year, that couldn't be further from what actually happened. And so I looked at it in the context of, if I focused on two main areas of the budget, the fire staffing plan, let's just call it $1.8 million, and the Board of Ed getting a 4% increase. In the prior year, they got a 3.3% increase, and in other years, the Board of Ed increases haven't been that large. This does not include the $437,000 that the board has talked about, and we've had conversations with the board about carrying over a lapsing Board of Ed lapsing fund, which, all things being equal, would also have an impact on fund balance, because that lapsing fund would have, the dollars that are lapsing would have come back to the town and flowed to fund balance. By considering the lapsing fund concept, one can make the case that is an additional use of fund balance. But I think what's worth commenting on is that if not for those items, then it would have effectively been a no tax increase. So if you had basically acted on the 6 and the 190,000, it gets you to a 2. If not for the fire, if not for the Board of Ed, then in apples to apples. And when I say that in general terms, because these are major programs. I mean, obviously every budget has its own smaller drivers and components. We for example, you recommended and the RTM approved the additional 2 police officers, but adding 2 police officers at times, can flow through a regular budget process. But again, if you focus on the major differences, it's Board of Ed, education, fire, public safety, and like I said, that would basically be a 0% increase if not for those items.
All right, Jim, thank you. Questions from the board on this? If not, then I will read a proposed resolution. Resolved that the Board of Finance established a mill rate for fiscal 24-25 at 30.48 mills pursuant to the budget adopted by the representative town meeting, coupled with an additional $690,000 from undesignated fund balance.
I'll move the resolution, Joe.
Been moved by Victor,
Second.
seconded by Harry. Is there discussion? All in favor?
Aye.
Okay, and with no other business to become before the board, I'll entertain a motion to adjourn.
So moved.
Second.
Motion been made and seconded by Jeff. All in favor?
Aye.
Thank you.
This program was brought to you in part through the support of the Town of Branford. Watch town meetings and other videos on demand at BranfordTV.org.